Welcome everyone. Thank you for joining us today. I'm 𝗖𝗽 Biniaz, co-CEO of CPI. I'm joined by my wonderful co-host, co-CEO of CPI, 𝗖𝗽 Benesocky. And welcome, 𝗖𝗽.
Thank you, August. Hi everyone, thank you for joining us this morning. We are really excited today to have 𝗖𝗽 from New York City joining us.
Well, I thought he was in Vancouver. The picture.
Okay, yeah, that's right. Thank you. 𝗖𝗽 is a powerhouse with property owners' tax savings. So that's pretty amazing. And as a business director at Madison Specs, a national cost segregation leader, he has assisted clients in saving tens of millions of dollars on tax through cost segregation. He has a background in teaching and a passion for real estate and helping people. He is a real estate investor and the host of the new podcast, 𝗖𝗽, which by the way is blowing up.
Nice.
𝗖𝗽.
I love that name, 𝗖𝗽. It's a catchy name. That's clever.
Now, real quickly, before starting our show, why don't we just really quickly jump into telling you a bit about us and what we do here at CPI.
Absolutely. We got to advertise CPI. It's our show's sponsor. It happens to be us, but yeah, quickly. So here at Canadian Passive Investing, we partner with investors to buy US multifamily assets, and we solve our investors' pain points.
Yes, pain points such as investing in the US, relief from double taxation. Our company literally files the taxes for our investors. So another one is the ability to partner with us to buy assets worth tens of millions of dollars. And one really exciting thing that we do here is we service non-accredited investors. Okay, so you don't have to be in the top 1% to invest like the top 1%.
Well said.
Another really cool thing is our minimum investment is $10,000.
$10,000 USD. And we made our company, our investment group, very inclusive. What we noticed is that this type of investments were only reserved for the top 1%, or you had to be worth millions of dollars to invest. But what we've done is we created this system with some relaxation on Canadian regulation to raise capital and the exemptions we use. It allows us to service non-accredited investors and the minimum $10,000. So if you'd like to join the movement, if you'd like to join us, please visit our website, Canadian Passive Investing, or please go on to tokenfunder.com. That's tokenfunder.com. That's our exempt market dealer, our broker dealer, what they call it in the US. And sign up to be ready for when our deals come alive and when we have a deal to present to you.
Exactly. We have 3 asset managers right now in Texas, Georgia, and Arizona, and they are bringing us diamonds in the rough. So make sure you stay tuned for that.
And just quickly here, before we introduce our guests and start with our show, if you have any questions or comments, please put them in the Q&A box. I have a quick comment here in the Q&A box about the Token Funder platform, so please visit that website if you need to. And yeah.
And we'll answer any questions that kind of come along. So welcome to our guest. 𝗖𝗽, thank you so much for being here.
Welcome.
It is my pleasure. Thank you guys for having me. This looks like a great platform you guys have in sharing education. I mean, for Canadian investors, I don't know if there's something like this that exists. So, kudos to you for putting this together. Awesome. And helping spread the word about, the awesomeness of multifamily investing.
Absolutely.
Thank you. And thank you for coming and educating the Canadians on this new topic that we're going to be discussing.
Absolutely. And we're looking forward to it. So please go ahead if you like.
Okay. So, 𝗖𝗽, as we said, you're a cost segregation specialist. Why don't you start off by telling us exactly what cost segregation is?
Yeah, exactly. We always got to get that weird name out of the way just to kind of figure it out. I mean, so before we even get into that, it's a tax saving. You guys mentioned about how you don't have the double taxation with Canada. And people have heard real estate has tremendous benefits, right? There's the equity, there's the wealth building, but the tax incentives, the tax advantages really boil down to what we're going to be talking about today, which is cost segregation. I mean, this is the number one key in creating wealth and paying little to no taxes by doing so. So cost segregation, it's again a weird name, but it basically means it's an advanced form of depreciation. Okay, it's just segregating the cost of depreciation. So let's just take a step back. What's depreciation, right? What is that? I don't know if you guys have this in Canada, but in the United States, the IRS, the Internal Revenue Service, has in the tax code something that says when you buy an investment property, any type of investment property, whether residential or commercial or a business property, as long as it's not your personal residence, any type of property, you get to take a tax deduction from your income tax called depreciation. Now, it sounds like the word, right? Depreciation means something going down in value, right? That's not really what it's about. It's based on that, but it's just a tax deduction based on that principle. So when you buy a building, let's say you buy a property for $1 million, okay? You can now take that $1 million as a tax write-off, right, over a long period of time. And that's called the depreciation deduction, as if it were that it was going down in value every year. So you can take that amount every year as a tax deduction as if it were actually going down in value. It doesn't really make a lot of sense from logic. Like, why would you do that? Because it's not intrinsic to the property, it's really for the investor. So if you buy a building today, right, you start over that depreciation schedule, you can take it, new from today. But that's what depreciation is, okay? And it's a huge thing. It's a great tax benefit and probably one of the best tax benefits that are out there until you figure out what cost segregation is, okay?
Nice.
No,
it's like magic.
Yeah,
it is.
No, for sure. And for me to jump in here quickly is, on news, on the media, you always hear about billionaires or the mega rich doing certain type of tax savings that they're practically paid less than their employees in taxes or barely pay nothing. And this is the incredible thing about apartment syndication, is where investors can partner with sponsors and with different teams and buy these assets in tens of millions of dollars and reap the benefits of the savings that exist for the mega rich. So it's cool. It's very cool concept.
Yeah, it's like you can immediately deduct this huge deduction from your income coming from the properties. So all that money coming in is basically tax not free all the time, but definitely reduced tremendously. So that's regular depreciation. And again, it's based on the purchase price, and it spreads out for commercial properties over a 39-year period. So you take that purchase price, take off land. Land is a certain amount that doesn't depreciate. So you always have a certain amount there you need to take off. But then you spread that over 39 years. For residential, including multifamily, is a 27.5-year schedule. Okay, which means you take that purchase price, subtract a little bit for land, then divide that by 27.5. You get every year that little deduction. That's called, not little, it's big, right? It's around $20,000 to $30,000 if you do the math. So from your purchase price, regular depreciation is getting you approximately between 2 to 3% of your purchase price a year. Okay, $20,000 to $30,000 a year on $1 million purchase. Okay, that's regular depreciation, which is huge. Okay, if you think about it, if you have a $30,000 write-off, like right off the bat, you made $50,000, $100,000 from your rental property. Right off the bat, take off $30,000. You're only taxed on the remaining amount, which is great.
Got it.
Cost segregation. Let's just jump right into it. Okay, it's segregating that cost. Okay, it's putting the cost, the overall purchase price of the building, into different buckets, to different categories that things in the property actually depreciate on different schedules, on different levels. So, for example, there's stuff in a property, right, your personal property, which can include a lot of things that you don't even consider personal, like, I don't know, furniture, anything that's movable, anything that's not part of the structure. So furniture, cabinets, right behind you, right, those beautiful cabinets there, all those things, those are going to be, the value of that depreciates on a 5-year schedule. And so there's a lot of other things that fit into that bucket, like carpeting, like equipment, appliances, window treatments, blinds, shades, those kind of things, lighting, a lot of different things that all the value of those assets depreciate on a 5-year schedule, which means, just translate that. So we're segregating that cost, that we're identifying what the value in all those things are, then taking that depreciation deduction at a faster rate over a 5-year period. Instead of $30,000 each year for 27.5 years, in the first 5 years, you can be doubling or tripling that deduction. So 30 turns into 60 or 90 or $100,000 each year over a 5-year, for the first 5 years. That, totally wipes out your tax liability. So you're basically getting all the returns without having to pay any taxes on it.
Great. And for me to jump in and ask a question that was very well way you explained it, but for me to quickly understand this, so if I had to put cost segregation in a sentence, it would be a system, an accounting system that is created to use depreciation of the physical assets, the physical structure's value to do tax savings. Is that a good way of putting it within one sentence, if I may?
I think so. That's a very good summary. It is. Yes. Although I will make one kind of tweak of that, because it involves an engineering component to it, which is why a lot of accountants don't even know about this or don't even employ this method, this strategy. It is a tax strategy, but because it employs the work of an engineer to identify what all those things are, which is why there are specialized cost segregation companies that do this, specializing in this study and this method, because accountants can't do this on their own. But so yeah, you are 100% correct. It's taking the building structure and all of it's in the tax code. That's the amazing thing. But they don't tell you, the IRS isn't coming out and telling you, yeah, this is how to do it. This is how you should be doing this. This is how you should be getting all these extra deductions. No, they're not telling you that. But it is a strategy. You're correct. How to use the building to get extra tax incentives. Creating more cash flow.
And we have a couple of questions about that particular point that you just made, but maybe Ava can jump in and ask this question here.
No, for sure, this is a good one.
Get our investors excited.
No, definitely. As you know, we're apartment syndicators. We partner with investors to buy assets. Could you tell us, how do these savings transfer to the investor and what that process entails?
So any property, right? Your depreciation is based on your purchase price, okay? So when you have investors, and again, like I said, the depreciation is based on the purchase price. You take, and for cost segregation, oftentimes we're getting 20 to 30% in a multifamily property that we're accelerating to a faster rate. So just to give that background. When you invest in a property, in a syndication, for example, usually you're given an equity portion of the percentage of ownership of that property. Based on your percentage of ownership, you get also a percentage of the depreciation deductions. So you're going to be getting your income, you're going to be getting your returns, whatever those dividends, whatever that is going to be. You will also be allocated that percentage of depreciation. So if you have, 10% of ownership of the property, you're going to be getting 10% of that depreciation. Now, in a $1 million property, think about this for a second. Let's say, and I do want to just clarify, it's based on your purchase price, which means if you are buying a property with financing, with leverage, you are going to be getting much more advantage of the depreciation because you're going to get the bank's money involved, but you're going to get the depreciation of the entire purchase price.
Wow.
That's awesome. Okay, thanks.
No, that's great. No, absolutely. And that's incredible. So this tax savings flow through to the investors. So that's amazing to hear.
Very cool.
If you like to.
No, another thing, we specialize in buying properties with a value add component. What I mean is there's a chance for us to upgrade these assets and create better living conditions for our tenants. In your opinion, is cost segregation something that is more helpful for certain vintage assets, or can cost segregation be used for an asset in any group?
Any age group.
Any age group, sorry.
That's a great question. It can be used for any age group.
Okay.
Because again, it is somewhat it's somewhat relative based on when the property was built originally, but since the purchase price determines and your depreciation schedule starts not intrinsically based on the property when it was built.
That's the point, right?
That's the point.
That's the key right there. Yeah, please say that again, Yona.
Yeah, absolutely. So the depreciation starts based on your purchase price and not intrinsically when the building was built. So you might buy a building that was built in 1925 and your depreciation schedule starts the day you buy the building. So you're taking that tax write-off over a 27-year schedule starting the day that you buy it based on your purchase price, not intrinsically based on when that property was built. However, there is a caveat to that because within the methodology of how cost segregation, how depreciation works, there is a covenant that makes sure that you are also applying the real depreciation value to the property. So it is a certain percentage. It's not like the whole thing, but there is a certain percentage that will be affected based on how old the property is.
Understood.
Great.
Awesome. Okay.
Yeah.
Thanks for clarifying.
No, for sure. Here, I got a question here for you. My background personally is in construction and development. So I'm guessing the cost segregation report to be created is very detailed, and it needs to be done by a certain team to provide that information to you. So then your team can use that information to create the cost segregation. So tell us about that collaboration that exists between yourself and the inspection group, or whoever is actually physically going to the property to see where things are at, if there is such a need.
Yes. So as I explained, it's an accounting method, but it employs an engineer component to it. So we have engineers in-house. It's a full in-house team, right? Everything is done by us that have the training in construction engineering, building engineering. And they are also trained in the tax code to understand what's called the MACRS. So MACRS stands for MACRS, which is the Modified Accelerated Cost Recovery System. That's the system in the tax code that actually delineates every detail of every type of property or component of a property in detail on what period it actually depreciates. So, farm equipment depreciates on a 7-year schedule, and the cabinets, inside a 5-year. So that whole thing, and it's a huge, huge document. And so they're trained in that. So if it were to be, an outside third party or something like that doing it, it would obviously be, that relationship would be much, maybe a little more disconnected, because you have one person finding this. Everything is done in-house by us. So we have accountants and engineers all working together that do this, day and night.
So would you be sending an inspector to the asset itself, or do you have like a subsidiary company where you hire to go and do these inspections for you?
Yeah, we do everything in-house. We send it to the property. So it's interesting. Until about 9 months ago or 8 months ago, right? Our company was doing this for the last 16 years. We have engineers who are stationed in different locations across the country and travel to properties when we needed to do that site inspection. Since COVID hit the world and travel restrictions became abundant and the social distancing, all that good stuff, we pivoted to do it virtually. So which means we are now doing almost all. We still do site visits when necessary, but for the vast majority, we're doing virtual site visits, which means the engineer will be on a video call with someone on site who can take them around, right? A property manager or a maintenance person, someone who has access to the units, to the building, to the site, to show them around, take the measurements, to do everything that they would be doing if they were there on site. In person, they're doing the same thing overall. But yes, it does require that full site visit because they're taking pictures, they're taking measurements, they need to see every detail of what's in the property and then come back and create this extremely detailed report, as you had mentioned. I mean, literally 80, 90, 100 pages long.
Yeah.
Very, very detailed.
That's amazing. And I was wondering, how long does a cost segregation study take?
Typically takes us around 3 to 4 weeks to complete. So it's not something that necessarily takes a long time. There's the collection of the data, and then there's the processing of it, the reviewing, et cetera, and applying that, which in the end of the day, all it does, this whole report, what it does is it pumps out one page.
Okay.
This huge report, but this one page is really all you need. That one page is the new depreciation schedule. That's what's going to tell you what your tax deductions are going to be this year and all the years going forward, because it's a one-time thing that you do on your property, and you have this set up. Your new depreciation schedule is set up based on these different buckets, these different categories going forward.
That is really cool.
Got it. And does it make sense to do the inspection closer to the tax filing date, or doesn't matter when in the year that it's done?
Nice question.
It makes you don't need to get it done before you file your taxes. So for example, right, 2020 taxes are due in March 15th, 2021. So you may have bought a property in 2020. You don't need to get this done until, ostensibly to have it completed before March 15th of next year. However, most people like to get this done as soon as they acquire the property, meaning because we want to come in and inspect the building as is, because we're basing our findings on the property at the acquisition. So the sooner to that time you can get it done, the better.
Got it. And that totally makes sense. I appreciate that. So now, Ava mentioned earlier that we are in the business of fix and flips. That's on a smaller scale, but essentially that's what we do. So there is a value add component that exists, and we do upgrade certain units if it's with new washer dryers or certain upgrades. So let's say we got into a property and we did the cost segregation study. Is that what is it called? Cost segregation study? Is that what the process? So we did a cost segregation study as we entered the property, but now within the first year or two, we did certain upgrades. Would your team then come back in and do a new study on that time as well? Is that how it kind of works?
Yeah, excellent point. As I mentioned before, the short answer is yes, potentially, but I'll explain why that is. As I mentioned before, the cost segregation, the depreciation in general, is based on your purchase price. Okay, so you're establishing how much you can take as a tax write-off over the next 27 years. Yeah. That doesn't change based on the value of the property. So if the value goes up, let's say in a year from now you do a refinance, you get an appraisal, and it's appraised for twice the value of what you bought it for, that doesn't change your depreciation. The only thing that changes your depreciation is if you actually add more money into the property. So those capital improvements, right? The expenditures you're doing to upgrade, like you're doing, you're saying a value add, you're replacing the appliances, for example, you're paving a new parking lot, something like that. All of that money spent is depreciated, which means that is added to your tax basis. And now you can take that as a tax deduction going forward. You can do, once you've completed a major renovation, for example, you can go and get an update to the cost segregation study. It's not a whole new study, but what it is taking all of the money that was spent and segregating those costs. Okay, nice. I use that cost segregation, right? We're separating all that money spent. So if you spent $50,000 on paving the parking lot, right? The money on the asphalt and the bollards and all the different things, all of that can be put on a 15-year schedule. That's accelerated depreciation, etc. And that goes with a lot of things as well. Structural things, as I mentioned, structural components of a property are depreciated on that longer 27.5-year schedule. That doesn't change. So if you're replacing the roof, that's structural. Windows, doors, those are structural. Walls, floor, etc. But things that can be movable, carpeting or cabinets, appliances, etc., all the different stuff, the cost of that can be accelerated.
Very cool.
Great.
Yona, we actually had a question that was emailed to us. And we heard of something called a bonus depreciation. What is it, and how does it impact a cost segregation study? Bonus.
Yeah, it's a really cool thing, right? Everyone loves bonuses, right? So
yeah.
So bonuses.
Good one.
Did you pull an A on us? You pulled an A on us. I can't believe this.
Awesome.
That was awesome.
The bonus depreciation, once you've done a cost segregation study and you have identified the assets in the building that depreciate at a faster rate. So we have basically the main buckets are the 5-year bucket, 5-year schedule, and the 15-year schedule. And those are different components, but those are the main two things. Some things depreciate on a 7-year schedule, some on a 10, but the main two are 5 and 15, which is accelerated from the original 27.5 or 39. Once you've done that and you've identified what those are, you can now opt, based on the recent tax reform, it was done a couple of years ago, the Tax Cuts and Jobs Act, you can now take 100% of that in the first year. Because this is called 100% bonus depreciation. That means all the accelerated depreciation, instead of spreading that over a 5-year period, you can take it all in the first year. So let me just illustrate what that means. Sure. Let's say you buy a building for $1 million, okay? Now you're always going to subtract a certain amount for the land, which does not depreciate. But you're remaining with, let's say, $800,000 because 20% is going to land. That $800,000 divided by 27.5 would have gotten you approximately $30,000 of depreciation a year, okay? Now doing cost segregation, you can allocate 20% of that to the first 5 years, $160,000 in the first 5 years, which over a 5-year period, taking approximately, right? How much is that? $45,000 or so every year for the next 5 years. Okay.
Wow.
Addition on top of the $30,000 that you were taking from the regular depreciation.
Very
so
cool.
You're really doubling your depreciation deduction over those first 5 years. What that does is With bonus depreciation, just to illustrate, you can choose to take the entire $160,000 as a tax write-off in the first year. Straight up off the bat. So that's going to create a huge tax loss. What we call it a loss, a passive loss, because if you have more deductions than you actually have income, then you create what's called a passive loss. It looks like on your tax return that you have negative income. You're like, what happened? I lost money? No, you actually made a lot of money, but you didn't pay tax on any of it. So you have more deductions than you have income. What happens with that passive loss? It doesn't go away. It actually carries forward. You can use it in future years. You can use it next year if you can't use it this year. However, this is a really cool thing in the tax code, that if you're a real estate professional, and I don't know if this applies for Canadians, but for Americans, it definitely does, that if you are what's called a real estate professional, and maybe it does, I'm not sure, I'd be interested in looking into that if you can claim this even if you're not American. If you're spending the majority of your time in the real estate trader business, which means you're brokering, you're doing renovations, you're operating, managing, etc., buying properties, all that time spent, you're spending it full time, you can use extra losses or extra deductions to offset other income besides for your real estate income. So let me just take a step back because I think I want to explain that a little clearer.
Yeah.
Sure.
Yeah,
real estate rental income is considered passive income from a tax perspective. It's considered passive, and rental property income is on a Schedule E. That's passive income. That income, depreciation, is considered a passive deduction because it's coming from your rental real estate property. So passive deductions are used first and foremost to offset your passive income. Okay, so if you made $50,000 from your real estate rental income and you have $50,000 of depreciation deductions, you knock that off, you're paying zero taxes on that $50,000. Okay, but what happens, let's say you made $50,000, but you have $200,000 of depreciation because you did a cost segregation, and you have $200,000 in bonus depreciation, right? And you have $200,000, you knock off that $50,000 you're not paying, and you've created what's called a $150,000 passive loss. Okay, usually what happens is that just carries forward. You don't use it this year, you can use it this year, next year, or future years. However, if you are a real estate professional, according to the US tax code, you're not limited to those passive losses to your passive income. You can actually use that against any active income you have as well. So if you're a broker and you're making money from your brokerage, or you are doing fix and flips, you're making money from that, or your spouse is a W-2 earner and you're a real estate professional, you can use the extra losses, the extra deductions against your ordinary income as well. So that's like huge. I mean, that's literally
really
the
cool.
biggest thing. I mean, talk about magic, right? This is beyond magic.
So I have a really, really cool question. How many people a day tell you that they love you? I just wanted to know because I'm really curious because I love you.
I don't know. Besides from my wife and kids,
we love you now. So now that's as far as
so
other
cool.
syndicators that are using this system. Do they use this savings, the one that you mentioned, do they do bonus appreciation, and do they use that in the first year? So kind of talk to us about what syndicators do, larger syndicators, I guess, people who are 100 units and above. Kind of tell us what's the common thing that they do.
I think it's different, but a lot of people do because, the syndicators themselves are usually have that real estate professional status, which means they want to take those benefits. They want to, use those tax deductions for their own personal tax benefits, whereas the investors may not be able to benefit from it this year. They can benefit from it in the future. It's not going to hurt them per se because it's just going to create a passive loss. It will carry forward. So I have seen the majority of syndicators using the bonus depreciation, and again, once you've done the conservation study, it's basically just an election. When we do the study, we create both schedules. So we will do the regular conservation depreciation schedule, and we'll do the bonus depreciation schedule, which means you can choose to use whichever number you want to use to apply to your taxes.
Got it. And
you have to pick one.
Yep.
You can't pick, for some people, your investors this, and others, you have to, for the whole property, you have to choose one.
Got it. And does it make a difference what your personal or your other income sources amount is if it's higher than what you've made from your real estate investment? So let's say somebody who's not a real estate professional, but they have an income in a different field. Let's say somebody's a doctor, but they invested in real estate. Now they have, let's say, they've made $100,000 from that investment this year, but they've had also $150,000 in loss. Now they got this extra $50,000. Does it matter what their income was from the other source? Does it matter if it's higher, lower? Can they still use it on that income?
You cannot, if you are not a real estate professional, you cannot use the extra deductions against your ordinary income.
Got it.
So it's only if either you or your spouse has that real estate professional status. And again, I don't think this applies to Canadians. I can definitely look into that, because I know it's in the tax code for the US, but that does not apply if you are not a real estate professional. Again, you're limited to those passive. It's called a passive loss limitation. So you're limited to how much of the passive loss you can use. Your ordinary income is not affected by that. However, I will say that it's against your rental property. So if you have multiple investments or you own multiple properties, you can use depreciation deductions from one property to offset income from another, because that's all in one bucket, the rental property income.
Got it.
Okay.
Got it. That makes sense. So tell us a bit about your group and how people can get in touch with you. You're very active on LinkedIn. We love following you, so we will promote you as much as we can, and we'll love to have you on again at some point. But tell us about your group and how people can get in touch with you.
Sure. So Madison Specs, the company I work for, I'm not the owner of the company. I'm an employee. So we're the largest national conservation company. We work in all 50 states, and now since everything's virtual, it makes it much easier to travel anywhere, right? It can be in Lincoln Park. What's this called? Lincoln Park?
No, it's Stanley Park.
Stanley
like
Park.
the Stanley Cup, Yes. Yes.
We could do this lighthouse over here, Segregation. Anywhere in the country. We have been in business doing this for 16 years. Before that, the founders of our company were at some of the largest tax accounting firms in the US, KPMG, and Grant Thornton, Ernst Young, the larger accounting firms, where they actually do conservation in-house. So the large accounting firms, the big ones who are really dealing with large corporations, usually they don't have individual clients most of the time. Individuals, they're doing it. They employ engineers in-house to do the conservation. So they kind of took their practice and became private. We've done over 17,000 conservation studies across the country, resulting in well over $3 billion in tax savings for our clients.
Wow.
Incredible.
So, yeah, you can reach out to me, 𝗖𝗼, that's me again. Find me on LinkedIn. I'm very active on LinkedIn, as you said, other social media as well, but that's the main place. You can go to 𝗖𝗼𝗜.com. That's
nice.
A little bit more about me. And like Ava mentioned in the beginning, the Wadhbh Advice podcast, which is a great way. We don't talk much about conservation there, but we do talk to real estate investors and successful people in the real estate industry, just to learn a little bit about more of them.
I look forward to being on that.
Yeah, Ava is.
I'm going to be coming on this month, I believe.
Oh, you are? Oh,
yeah.
Amazing.
Yeah.
Amazing.
So look out for that.
And I have to say, Yona literally has the best LinkedIn. Just how much you're involved in your LinkedIn that I've ever seen. It's just incredible. He does shout outs to people. He includes everybody. It's like a big family. I love that you're doing so well that you're like, should I post more podcasts or should I not post? I'm like, post more. I think it's just incredible what you're doing.
No, amazing.
I love learning. I love learning
sure.
from you.
And we learn about Yona from many different platforms that exist. So lots of podcasts out there, lots of YouTube videos. So he's a very constant face on many different platforms. So our Canadian investors might not seem as familiar, but if you're in this apartment syndication, you can see him speaking on many different summits and events and webinars and podcasts and what have you. Can I ask you a couple of final questions here? Is there a red line where people can use this concept of cost segregation when it comes to the asset's value? Like, obviously our asset criteria is 100 plus, is like kind of 100 to 300, 400 unit apartment buildings, that 20 to 50 million dollar USD price range, but how far low can this be used in? Could it possibly be used in a duplex or a fourplex? Kind of give us a...
Sure, it can be used on any size or type of property whatsoever. Usually what I will give as a rule of thumb, and again, this has a lot to do with the percentages, because we're talking about percentages of how much the purchase price is going to be depreciated at a faster rate, right? Maybe 15, 20, 30%. So if you have a building that's purchased for over $500,000, that's usually my rule of thumb. Doesn't matter if it's single family, duplex, 100 units, what you name it, can be done. Doesn't matter if it's retail or office or industrial or self-storage or you name it, any type of property can benefit from it. One of the things we do is we always run a free analysis up front, which means you can send us some basic information about the property. We can already tell you beforehand, without having to do the full cost variation study, how much you're going to be potentially saving. So how much that's going to create in terms of the depreciation, you already know ahead of time. So that's something that I highly recommend anyone looking into getting this done, definitely reach out and get one of those analyses. The other thing is for single families, because I know a lot of people start out with single families and you move from there to get into multifamily. We started recently doing those for much, much cheaper. Usually, and I should mention this, it does cost money to get a cost variation study done. Typically, it's somewhere between $4,000 to $6,000 is a full cost variation study. So again, that's going to factor in what's my tax benefit going to be. If I have a $1 million property and I'm getting, approximately $150,000 of tax benefit, it makes sense to pay a few $1,000s, right? If I have a $100,000 property and I'm going to get about 10, 15,000, does it make sense to have? Probably not, right? Probably not, doesn't make sense. So what we started doing for single families, much cheaper, so around $1,000 for single family property. So it starts to make sense more even for people who have maybe a portfolio and they want to get their single families done. It can be beneficial for them as well.
Amazing,
awesome.
Amazing. Yeah, just had to get that out there. Hey man, we really appreciate your time coming
really
on.
do.
Looking forward to bringing you on to do the work for our deals. And just a quick question on that. Sorry,
he can't let you go.
I can't let you go.
He doesn't want to let you go.
Whenever I get professionals, experts, I gotta ask them. At what point should the sponsor engage you into the project? So if we're looking at something, do you get involved after completion and closing, or should we get in touch with you right away? What's the best point there too?
A lot of people even reach out to me even before closing. So for example, they'll want to see ahead of time what the potential tax savings are going to be. They can reach out for that free analysis even before you close on the property. So once you have something on the contract and you know what you're going to be getting, when you're going to be purchasing, you should look into getting that cost variation study done, at least that analysis, to see how much you're going to do. But the study itself, usually people do it after closing. It can be done the first year. It can even be done retroactively. If you own a property for a number of years, you can do it and get the tax savings retroactively.
Oh, amazing.
Very cool. So
amazing.
we'll be calling you for that.
Absolutely.
That initial.
Absolutely. Okay, great. That was great. We really appreciate your time.
Yeah. Are you going to let him go this time?
Yeah. Okay. No more questions. Promise to let you go. We really appreciate it. Have a wonderful day. And we'll chat with you again soon.
And thanks for coming to beautiful Vancouver to hang out with us.
If you actually come here, not virtually, we'd love to take you out sometime and go grab a bite to eat after everything goes back to normal.
I'll take him to the lighthouse behind him.
Oh, exactly.
I'll take him there.
We'll take him.
Yeah.
Absolutely.
Awesome. Okay, Yona,
perfect.
have the best day.
Okay, my friend.
We'll be in touch.
All the best.
Thank you guys.
Okay.
Take care.
Bye-bye. Bye.